Welcome to Retirement Unpacked, a weekly podcast by Parallel Wealth. I'm Adam Bornn, and each week, along with our team of experienced financial planners, we'll explore the ins and outs of retirement, from income strategies to taxes, lifestyle choices, and everything in between. Before we dive in, a quick note. What we share here is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so be sure to talk to a qualified financial planner before making decisions about your retirement. Let's get started. So welcome to the very first episode of our podcast. We're really excited to do this. Brett and I have been talking about this for a long time. So my name's Adam Bornn. I am the founder and managing partner here at Parallel Wealth. And Brett Martinson is the other co-host here, who's the manager of our planning team. I'll let Brett quickly say hi and introduce himself.
Sure. Yeah. I'm Brett Martinson. Been in the industry for about 13 plus years now, certified financial planner. And as you mentioned, managing the planning team as well as doing planning myself.
Yeah, perfect. So the idea of this podcast is really to answer your questions. So comments that you leave on YouTube or other platforms for our team. And Brett and I have these conversations week in, week out. We thought, hey, let's actually move this to a place where everyone gets the answers, because a lot of the questions apply to a lot of our viewers. So in this podcast, we're going to work on going through questions that you guys have. We'll go through a bit of a case study. We'll go through an article that we found in the news that a lot of you are probably reading, and what does this mean and what does it mean to me? And then at the very end, we're going to give a tip for the week, kind of leave you walking away with, hey, I didn't know that, or maybe you didn't know that, or some nuances to something. So let's jump right into it here, Brett. So the very first question, and this came from a YouTube comment here on a video that you did not too long ago. I understand there's a max amount the survivor can collect, say $1,433. We're talking about the Canada Pension Plan here. But what if the survivor deferred their CPP till 70? Would he or she not be entitled to the increased amount for delaying CPP? Meaning that, if someone delayed CPP to 70, they're going to get more money. They get 8.4% more every single month. So if I delay it to 70 but die, what does that look like? So would he not be entitled to the increased amount for the delayed CPP and whatever the late wife survivor's benefit was? Or is there just a maximum amount regardless of the delay? So maybe I'll let you jump into that there, Brett.
Yeah. So, I think I'll just quickly clarify for me as well as everybody else potentially listening that what I see this as is I'm a husband, my wife passes away, I am considering or have deferred my CPP until 70. And so what happens in this circumstance? So spouse one is deferring to 70, spouse two has passed away. So there's a number of kind of things here to kind of break down. So would the surviving spouse not be entitled to the increased amount for delaying CPP? The answer there is yes. So regardless of survivor CPP benefit or when somebody passed away or anything like that, the more I wait to take my CPP, the more I will get a larger benefit. Whether that's right or not for you is an entirely different conversation, but mathematically, yes. So would I not be entitled to the increased amount plus whatever the late wife's survivor's benefit was? Here's where it gets tricky. Because when you are receiving a survivor benefit and then you start your CPP, there is a calculation that goes on. And that calculation, A, combines those two, but it's not the sum of the two. So for example, let's say I'm receiving a survivor benefit of $500 a month, and my CPP is going to be $1,500 a month. So my combined benefit when I start my CPP will almost not be $2,000 a month. In fact, I'm pretty sure I can say that it will not be. Mathematically, it will always be less than the sum. Number one. Yeah. Number two, it will never be more than what one person can receive as maximum CPP. So if it's confusing, the answer is yes, it is confusing because there's a number of calculations that CRA or Service Canada goes through at that point.
And I think what they're really digging into is because of delayed CPP to 70, I got a bigger amount. So will the survivor benefit be bigger because of that? The answer is no. It's survivor benefit is based on age 65. So when your spouse passes away, even if they delayed their CPP to 70 and your survivor benefits, 60% of their amount, it's 60% at the age 65 number. Now, this shouldn't play into the factor of, well, I should then take my CPP at 65 versus 70. But yeah, the survivor benefit is different if it's pre-65 or post-65. But the survivor benefit past 65 is based on what you would have collected at 65, even if you delayed till 70. And then, yeah, like you said, Brett, you add in the second layer of it of, okay, yeah, there's 60%, but there's also the grand total. Like the most I can collect is the maximum CPP, which here in 2025 is $1,433 per month. So that also comes into it. So if you're collecting 1,000 and 60% of your spouse is, $600, you're not going to get $1,600. You're going to get $1,433. That's the maximum amount you can get. So yeah, lots of layers here. But I think what this person was really digging into was, if I delay till 70 and I pass away, will that help my spouse get more as a survivor benefit? And yeah, the straight out answer there is no. So Brett, let's go jump into the next question here.
The good news about question number 1 there is that that's the only confusing part of the Income Tax Act. Everything else is really straightforward after that.
Yeah, all 5,000. And you're the type, and this is why I love Brett. We're the type that's probably read it word for word. So there we go. Yeah.
Well, I don't know if I've made it all the way through. Yeah. Sorry. Number 2 here. So when you say cash wedge, this is another comment that's come up. When you say cash wedge, do you mean money sitting in GICs, maturing at different dates? So what is known as a GIC ladder, to accompany OAS so you can delay CPP? So another, I think, a multi-layered question. Adam, I'll throw this one to you.
Yeah, the cash wedge, it's something that we talk about a lot. And do you mean money sitting in GICs? Yeah, it could be. We've had clients that, they know what they need down the road. So they'll have a maturity, early in the year for the amount of money they need. So let's say your RRSP or your RRIF, you need $30,000 out of your RRIF that year. Well, and for the next few years, you could have a $30,000 GIC maturing in January of every year for the next 3 to 5 to 10 years. And it matured in January. You have your cash flow for the year. You get perfect. That's a cash wedge. A cash wedge, by definition, is making sure you have money to pay yourself in retirement without selling anything in the stock market. That could be a GIC. It could be a hydro savings. It could be a direct bond. There's many ways to build out the cash wedge. But yeah, maturing GIC could be one of them. Part of your cash wedge, you always say, is dividends or interest income that you're generating as well. So if you need $30,000 out of your RRIF, but your dividends are $10,000 a year, then if you wanted to take the GIC route, you would only need a $20,000 GIC at that point every year. So look at how things are structured, how much natural cash flow would be coming in, again, through dividends and interest. But yeah, absolutely. So
do you mean just to quickly touch on the last part of that? So do you mean money sitting in GICs at different dates to accompany OAS so you can delay CPP? I would say the cash wedge doesn't really have anything to do with whether or not you're going to delay CPP. That's a different conversation. It's more of, as you said, that when you're withdrawing this money so you can go and enjoy your retirement, the last thing you want is to be able to say, oh my gosh, the market is down 30%. Now I have to spend 30% less than I was thinking about doing. No, it's about, I have this bucket of money that I can go and withdraw because it didn't go down 30%. And off I go and enjoy my retirement. We're not talking about delaying CPP at this point.
Yeah. And cash wedge is something I could talk for days on. But yeah, there's no, and actually into the case study later, I want to talk about that. So we'll jump back into cash wedge. But the next question we got was, it would be great if you highlighted a video on larger purchases, i.e. vehicles, trucks, boats, etc. In the current market, should we buy? How to buy, purchase with cash? Where from? TFSA, bank account, lease, etc. And then, are the inflated rates on vehicles going to come down? Do we wait? Well, I'll answer that right now. I don't have a crystal ball. Yes, rates are up. I know, like, every car manufacturer has been a bit different, but will they come down? I mean, nobody has a crystal ball, so that's a tough one to answer. But I would hate to see inflated dollars go down at the dealership in the near future. As far as big purchases, so I'm a cash for car guy. If you can't afford to pay cash for your vehicle, you can't afford the vehicle. You got to look for something different. That's my personal opinion. If you get a company budget, a lot of people think, well, I get $500 a month, for a vehicle allowance. I'm going to lease a vehicle. Okay, but could you not go buy a vehicle cost you less than that, pocket the $500. Like my brother does that. I have clients that do that, right? So it's the budget is for a vehicle that, but it could be a vehicle you own. Doesn't mean you have to go lease or finance a vehicle. So yeah, I'll go back to my big thing is cash for cars. So where do you get the money from? Yeah, it could be cash in a bank account. It could be your TFSA. Again, typically your plan will drive this. We like to show, Brett, our team likes to show one-time expenses in the plan. So, you have your ongoing $60,000 a year, but in 3 years from now, you need $40,000 for a car. So we'll put that as an additional expense. And then we can actually see, okay, based on your assets, and the answer of where the money comes from is going to be different for everybody because we all have assets in different spots. I mean, if you have $40,000 sitting in a bank account, that might be a good spot to grab it from. TFSA, non-reg, typically pulling money from an RRSP to buy a car isn't going to be a good plan, a tax plan. So that's typically not. But as far as I would say, don't lease, don't finance, pay cash for vehicles. You will thank your future self. And that's a good starting point.
Yeah. And to go to the why we put it in as a one-time expense rather than build in a loan or something like that is I feel that putting it in as a one-time expense stress tests the plan more often than it doesn't. And what I mean by that is if I'm going to yank out $40,000 at 1 year for a car, that's $40,000 I've just taken out of your investments, for example, or even in your bank account making 2%, whatever the case may be. So I'm possibly costing you money in your plan by doing that. Now, whether you take a short-term loan, 3 or 5 year, zero finance loan, whatever you do, at least the plan has shown that you can yank this money out of your life, of your net worth, and give it to somebody else or another organization, get a car for it, and your plan still works. If there's a 0% financing at that time and you want to take advantage of that and you feel comfortable and confident doing that, fantastic. It's just all about stress testing the plan for me.
Exactly. And I caution people on the 0% financing because people typically buy a more expensive vehicle because of that. So that's where even I'm the type, even if there's 0%, and I know from a financial standpoint, this doesn't make sense, but it's a psychological thing, right? I saw an interview with Dave Ramsey the other day and he's like zero debt. Like he's a zero debt guy. And, it was Graham Stephan down in the States on YouTube was asking him, if you could get a 5-year, if I give you $1 billion for 5 years, interest-free, absolutely interest-free, would you take it? Mm-hmm. He goes, no. He's like, but you could put it in T-bills in the States at 2% and he's like, no, I don't want borrowed money. It's zero. And, that is obviously a very extreme stance. I think most of us should and would do that. But I think the idea is people stretch them. I do some financial courses with younger couples and people that are having a tough time in their finances. And the number one thing that cripples people's finances is vehicles. Yeah. By far and away, the number one crutch of people not getting ahead, not getting to retirement, not building wealth is vehicles. And I mean, for most of you, just drive around your community, right? There's typically 2 fairly new vehicles in most driveways. And I can tell you that most people don't pay cash for that. They finance it, they've leased it. They don't actually own that vehicle, right? Yeah. The bank owns it, the dealership owns it. They're just using it. They basically rented that vehicle. And I know a lot of people fall into that trap, keeping up with the Joneses, right? It's well, my neighbor got that new vehicle. It's ask him how he paid for it, right? Yeah. It's probably not cash, meaning that he's borrowing that vehicle. It is not his. So, if you want to get ahead financially, make sound decisions when it comes to vehicles, to larger purchases in general, like boats, trucks. I mean, boats are not a great investment, but they're a great memory maker. So that's where this balance. Can you afford it? Like you talked about, Brett. Does it fit into the plan? Does it derail it? Affordability, et cetera. We're not saying don't do this stuff. We're just make sure it fits into the plan.
Go in with it eyes wide open. And if your neighbors bought that nice new vehicle, as you said, ask them how they paid for it. And while you're at it, ask them for a copy of their net worth statement and investment statements and see how their plan's going.
Yeah, exactly. So you guys retiring at 55 or 60? It's no, we're working until 80 because we have this nice vehicle that we've rented.
But look at the Ferrari. Look at the Ferrari. Yeah.
So true. So true. All right, I'll let you jump into the next one.
Yeah, so this actually came from our masterclass course, a comment that came through somebody who's going through our masterclass course. I've currently contributed about 50% of the contribution limit of about $102,000. So we're talking TFSAs here. I've currently contributed about 50% of the contribution limit of $102,000, which is the maximum cumulative limit as of 2025. Is there any reason or any way to exceed annual contribution limit of approximately $7,000 to get caught up? Do you want to start off with that one, Adam? Or do you want me to jump in? Or
yeah, our team went back and forth a little bit with this person, just kind of explain it. Then they had a few more questions, but it was really like, I have all this room, like, so it's 50%. So they have $51,000 of room left, let's say 50% of the 102, like, but I can only put in 7 a year. So how do I get caught up? The reality is they could put the full 51,000, which is what this person didn't understand is your annual contribution. So if you were at least 18 in 2009 when TFSAs were launched, and you have not, you've been in Canada the whole time, and you have not touched or put money into a TFSA, and 2025 you decided, you know what, I got an inheritance or lump sum of money, I want to put money in. Although 2025's contribution limit is $7,000, your lifetime limit is what you're able to put in. So you could put in $102,000 this year and not over contribute. Then come 2026, you could make a further contribution. So yeah, what this person was running up against was, well, like, I've already, I put in half, I still have a lot more, but it was bumping up against this 51,000 of contribution room, but I can only put in 7. The 7 is just a new contribution room every year. So again, we got back to them. Yes, you can put in $51,000 and let that money grow.
Yeah, exactly. The 7,000 is just how much more has been added to your TFSA contribution room. It is not a limit in terms of how much you can put in. That's a different number.
Yep. Exactly. Question 5, which actually stays in the TFSA lane here. Confirming your TFSA contribution room, including the math, air bracket math, needed from the January 1st number provided by CRA. This is something that I would say 99% of Canadians bump into, whether they realize it or not. So the math needed from the January 1st number provided by CRA, and the fact this information is usually not available from January to February as CRA updates your number. So what we're talking about here is if you log into your CRA account to look at your TFSA contribution limit. So when you log into your CRA account, you can see both your TFSA and your RRSP contribution limit. But in January, that hasn't been updated for your TFSA yet. So when we're talking about TFSA here, you're going to log in and see, oh, I still have, let's take this last example. I still have $51,000 of contribution room left. But if that person had made the contribution room now, like let's say July of 2022, August, September, October, they've made it at some point in 2025, January 2026 is still going to show they have that contribution room because it hasn't been processed. And again, it doesn't get really processed until your taxes are filed. And so I would say in the first quarter of the year, until you file your taxes, really, the contribution room on your TFSA on CRA's website is likely inaccurate. And it will be inaccurate if you've made contribution rooms or withdrawals the previous year.
Yeah, they're very careful to indicate that number on your CRA account as of January 1st. So the number in my CRA is always going to be as of January 1st of the current year. So if I log into my CRA account now, if I log into my CRA account 3 months from now, December 24th, it's going to say the same number because it's always as of the start of the year. And so in this person's case, if it says $51,000, okay, great. That was your total contribution limit that you could put in as of January 1st this year. And as you said, now you got to do the math. Did you make any contributions during this year? Yeah, I put in $20,000. Okay, now that $51,000 is reduced by $20,000. Now you've got $31,000 of room, and so on and so on. And unfortunately, that number is usually not available at all on my CRA during January and February, because CRA is collecting all your TFSA contribution and withdrawal information from the previous years and all kinds of crazy stuff to give you an updated number come March-ish, or this year in 2025. Unfortunately, there were issues that took us until July, I think. But that's check that number. And if you're not comfortable doing it, work with somebody who is monitoring your TFSAs and is comfortable being able to have an updated number, because you do not want to over contribute because you will be penalized. And usually you don't find out until you submit your tax return the next year. That could be months of penalties assessed against you.
Yep. And CRA has been finally assessing penalties. So, we've seen people fined, hundreds and thousands of dollars for over contribution. At the beginning, they were being very, graceful and saying, you know what, don't do it again. We're not going to fine you this time. But they've definitely been fining people the last few years. So be very aware of that. Let's just run through a couple examples here, because I think this does apply to the majority of our listeners here. So let's say 2025, you've maxed out to the point you put in your full $102,000 into your TFSA room. So you've maxed it out for your lifetime. Come January 1st, 2026, let's assume it's a $7,000 contribution room still in 2026. You can put in that $7,000. It's a new year. You have new contribution room. So if in 2025, let's say you didn't make that contribution of $7,000. So when you log into CRA in January of 2026, it's going to say you have contribution room of $7,000, which is the room from last year, 2025, that you did not use. So in January 2026, you could put in that 2025 contribution that you missed, plus the $7,000 for 2026. So even though online it says you only have $7,000 in a room, you actually have $14,000 in a room. So that's one thing that a lot of people fall into. The other example would be, what if I took money out of my TFSA? So let's say early January of 2025, you put in your $7,000, you've maxed out your TFSA $102,000, and later in the year, you took $10,000 out. Come January, when you take money out of a TFSA, you get that contribution room back January the following year. So if you took money out, so you maxed out in January, you took money out in July, you can't put money back in. You've already maxed out your TFSA. Even though you took money out, you cannot put money back in. We cannot stress that enough until January of 2026. Come January 2026, you can put that $10,000 back in, plus your new $7,000 of contribution room. So in that case, it would be $17,000 that someone could contribute. So again, everyone's situation is going to be different here, but just track it. Like if you're doing some transactions within your TFSA account throughout the year, track it and have a clear understanding. Because you don't want to over contribute, but you also don't want to not contribute because you have no idea what's going on. So again, can your advisor track this? Yeah, they might be able to track it a little bit, but I would say track it yourself as well. It shouldn't be that hard. Grab an Excel spreadsheet and start working through that yourself too.
Yeah. I'll have to correct something I said earlier, Adam. The first question and this part is the only two areas of the Income Tax Act that are confusing. Everything else is straightforward.
Yeah. Okay.
I forgot the TFSA part. Those are the only two parts of the Income Tax Act that are confusing. Everything else, easy peasy.
Easy peasy. Yeah, there you go.
until we get to two more questions down the road, then there'll be a third area of the Income Tax Act.
We'll find another one. I'm sure no one else
but
has.
Most of it is pretty straightforward. So you might have actually touched on the next one here, because again, it's still in the TFSA lane. You used an example of $150,000 in a TFSA. So I think during one of your YouTube videos or something like that, Adam, you may have said, hey, I've got $150,000 of TFSA room. I thought the max was $102,000. Does interest made from TFSA count towards max TFSA limit? And the quick answer to that is yes. Yes, it does. I often explain the TFSA like a balloon. I've never put money in my TFSA, let's say. I put $10,000 in. And that $10,000 increases to $20,000. I, double my money. And then I withdraw that $20,000. I've actually increased my TFSA room by $10,000. I inflated the balloon. The opposite could happen. I put $10,000 in and that money goes to virtually nothing or goes to $1,000. And then I withdraw that money. I've lost $9,000 of TFSA room that I cannot recover. The only way I can recover it is put $1,000 back in and hope that grows to $10,000. Yeah. So there is great potential of reward, but there's also great potential of risk in the TFSA, depending on how you're investing it. But to circle back to this one, I don't know if you've got anything else to add to that, but yes, when you used $150,000 as an example, it is possible to have more than the cumulative limit. So again, 2025, the cumulative limit is $102,000. But it is possible to have more than that, depending on how you invested, what has grown, what you've withdrawn, what you've added back in.
Exactly. And we have a lot of clients that like, well, I put 50,000 into my TFSA, so you should be able to know my limit. And it's like, well, no, because if you made some money in the past, you took it out, you could have a bigger limit than 102. If you've lost money and taken it out, you could have lower than 102. And that's why it's important to really understand. And again, be careful what you look at early in the year with your TFSA limit, but it's good to track it. I encourage everyone to track their limit. But yeah, absolutely. You could have, we've had clients with hundreds of thousands in their TFSA because some investments that just done very well. No, they haven't even necessarily cashed any of that out. It's just the account's grown. But if your TFSA, you put in 102, it grows to $300,000 and then you cash it out for something, the following year, you can contribute $300,000, not 102, the $300,000, because that's what you pulled out. Well, 300,000 plus the new contribution room for that year too. So
exactly.
It's something not a lot of people are aware of. So yeah, lots of TFSA talk, but again, TFSA is such a powerful tool here in Canada that people need to be aware of. So yeah, it's good to do. So let's jump into what we saw this week. I just want to talk about, and this is, we have a bit of scripted stuff in this podcast, a bit of unscripted. This is more unscripted, but I was talking to a client. So a client did a fee for service plan with our team about a month ago, and he just looped back with me and said, "Hey, can we have a quick chat about like this cash wedge, which we talked about earlier in today's podcast?" And he said, like, I think I have it right, but I'm not sure. And so I just want to use his example because it was a bit extreme. He actually had, about $1 million of ladder GICs. And so he like had 100%. So he basically bought all these GICs back when he could get 5%. Now they're all renewing at 2 or 3. Doesn't make sense for him anymore. And he knows that. So he's trying to like massage this. And I said, you actually have like a lifetime cash wedge built out. But now the problem is your plan showed a 5% rate of return, which you're getting on your current GICs. You're not going to get on your GICs going forward. So it's almost like he had overbuilt the cash wedge and we were like unbundling it, but making sure we were protecting for it. So what we ended up like kind of coming down to is he's got GICs coming up at the end of every year. So he's got some coming up in November this year. His retirement income starts in January. So I said, look, like figure out how much interest income you're generating on your GICs and other investments, etc. So figure out like, is there any cash flow from your investments? What is your cash need for next year? So it's $50,000 he needed next year. This is all RSP or RRIF money.
Sure.
And so he had $100,000 maturing in November. He needed $50,000 for 2026. And he had a bit of interest income and stuff coming in. So he had about 10,000 there. So he needed 40,000. So I said, look, take of your 100 maturing. Let's move 40,000 into just a high interest savings, something that's there protected, not in the market. But the other 60, we actually need to get working for you.
Yeah.
And we kind of looked at his plan and figured like he doesn't need that 60 for many, many years because he's got so many ladder GICs coming due over the next X amount of years. So we actually said, look, that 60,000 is actually going to be for like 10 or 15 years from now. So we actually need to get it invested. What he invests in, he's going to figure that out. We don't get into that. But you need to get it working for you so that your overall return was 5%. So that is something we bumped up against this week. So when you build your cash wedge, a lot of people argue like, well, I don't want money not working for me. Well, typically it's a small percentage and the rest should be working for you. And that's the purpose of a cash wedge is let's protect the next, say, 3 to 5 years of cash flow. But let's also make sure the rest of it that we don't need for 5 years is actually working for us. Because a lot of people enter retirement, they're like, whoa, I need my cash flow. Got to be safe, got to be 50-50 or 40-60, or they go too conservative. Go conservative with what you need, but the rest of it, like depending on your risk tolerance, etc., should be working for you to try and get to that rate of return you're needing to make the, your goals and plan within your overall retirement plan.
Yeah, exactly. One of the things I'll tell clients is the best financial plan is sleeping at night. So in terms of a cash wedge, it really is what makes you sleep at night. When I used to manage investments, I used to tell clients, I'm going to invest your money like 2008 happens tomorrow. And what I meant by that is that stocks went down, depending on the indice you look at, but stocks went down and took 2 to 3 years to get back up to where they were. So over time, historically, the stock market goes up. Not guaranteed, but historically it does. But those moments that it goes down and decides to stay down for a while, early 2020, who knew how long that was going to stay down? Funny enough, the year ended up as a banger year, but we didn't know that at the moment. So sleeping at night means I have a certain amount of money that I'm going to live off of while I wait for my other money to rebound. For some people, that is a 3-year cash wedge, maybe 5 years. We can talk about what might be or may not be extreme, but what makes you sleep at night is the key thing there. So if you can sleep at night with a year to year and a half worth of cash wedge and the rest invested for growth, maybe that's a good idea. Maybe it isn't, but it makes you sleep at night. If you need 4 years of cash, GICs, whatever the mix may be, and then the rest is going for growth, great. At least you're sleeping at night and enjoying your retirement and not worrying about your money. So it's different for everybody. Yeah, exactly.
Absolutely. And we've had clients say, no, I'm full GIC. So when my 5% goes to 2.5, that's what I'm doing. So then it's okay. Well, have the plan built that way. And you can still support your retirement based on a 2% rate of return. So go for it, right? Like we always say to our clients, like, you've worked hard to get to this point. Let's make sure you now enjoy it, not stress about it. So whatever that looks like for you, it's the key. So article of the week. So being a podcast, obviously we can't show the article here, which is new to us, but it was in advisor.ca. And this is something a lot of you are going to be bumping up against. If you have an advisor, whether that's at, a bank, a Raymond James, an Edward Jones, IG, it doesn't matter where it is, like any big investment firm, planning firm, financial institution across the country, a lot of them are moving to more of a fee-based model. So the old traditional model, like if we go back to the 80s, 90s, it was front end loaded. So if you buy a mutual fund with me, I'm going to charge you 5 to 10% up front. So if you give me $100,000, your 95 will go into the investments and I'm going to take my $5,000. Then it transitioned to what we call the deferred sales charge structure, which is, you give me $100,000, it's all going to be invested. But if you pull your money out in the first 7 years, you're going to be charged back a bit. So, it started at 7%, scales down to 1% in the last year. So that was the model from, let's say, 2000 to about 2015, 2018. Deferred sales charge, roughly, ballpark. DSCs have kind of gone away now. A lot of advisors are now going to what we see is it's called F class or fee-based solution. And that's really unbundling, which is good to see in that before your mutual fund, let's say, was 2.5% fee, 1% was being paid to the advisor, 1.5% to the financial institution, investment firm, etc. That's now kind of broken out. So an F class, so if your advisor says, hey, we're actually moving to a fee-based model, it's the same fund. So you own ABC Balance Fund. So it looks and feels the same and does the same. It's just a different series. So it's moving from series, say, A to F. And again, what's confusing is every financial institution has a different series and they don't line up, and it's very confusing for the consumer, which needs to be fixed. That's for another podcast. But when they're moving to this F class or fee-based model, some are series O I've seen as well. So, but it's a fee-based, and really what it is, it's unbundling. So the advisor says, look, I'm going to charge you my 1% directly, and then the fund is going to charge its fee, which is often 1.5% as well. So you might be sitting there saying, like, okay, who does this help? At the end of the day, typically your overall fee is going to be fairly similar. Rarely do we see it come down. I've seen it go up, in fact, because a lot of times advisors are getting paid 0.75, 0.85, and they'll bump their fee up to 1. But let's say in general, your fee is going to be the same. What it brings is transparency, seeing where your fees are going to. So I don't have a problem. We actually started moving to fee-based back in, I think it was 2013 was when we were back in the mutual fund game. It was kind of early on. F-class funds were just being launched at that time. But I think at the end of the day, what I took from this article and why I want to bring it up here is if you have that conversation that your advisor has it with you of, hey, we're making some changes and we're looking to do this, the questions to ask are, how are you getting paid? How much are you getting paid? And are my fees going up or down? And by how much?
Yeah.
Full transparency. And, mutual fund fees are a bit of a black box. Sometimes they're hard to find. And what is the total fee and all that? So I think for a lot of you that are still working with an advisor and paying, a fee like that, you should know exactly what you pay. Not on a percentage. I think that's good, but from a dollar number, right? Like if you have $1 million and you're like, I'm paying 2.5%. Well, that's $25,000 a year. What are you getting for it? Right.
Mm-hmm.
And so that's part of this conversation too, is the unbundling of fees. It's like your advisor is now coming to you saying, I'm going to charge you 1%. And the investment firm is charging you, let's say 1% on the product. Okay, well, the investment firm is the one that's choosing which stocks and stuff to own in the fund. So I would ask your advisor, okay, you're charging me 1%. What am I getting for that? Like the planning, the tax, estate, the retirement plan, the financial planning. If it's, I'm paying you to pick what funds I'm in, there's a disconnect. That is not worth the 1%. So I think this is a good opportunity in our industry to really get, the good advisors will add a lot of value. So they're going to separate out their fee and say, look, yeah, I'm charging you 1%, but we're going to do retirement planning or financial planning, tax, estate. Like we're actually going to dig into stuff. And the fund over here that's always been doing your investments, they'll keep doing that, but we're unbundling stuff now. So yeah, sorry about that's a lot of talking. I'll let you jump in here.
No, that's all right. No, as you're talking, I'm thinking about, unfortunately, how slow industry sometimes move, because when I started in the financial industry with Sun Life, I think it's coming up on 14 years ago. So whether or not these funds were available at that time, being relatively new, I wasn't necessarily aware of them. But within about 3 to 5 years after that, so now we're getting into, let's call it 2018-ish, 2017, you started to hear about them a little bit more. I always, I had a lot of great mentors. One guided me in this area. So shout out to Moomin, that when we worked with clients, we would say, like, we're separating our fee. We're going to show you what we get paid. And the mutual fund company is going to show you what they get paid. And you would also show the dollar value. And as well, we would list, okay, and here's what we're doing. And like, here's the mutual fund company. And here's what they're doing for that money. And here's what we're doing for this money. Because I still tell clients today, I would be happy to pay 7% MER. And we're not talking just mutual funds here, ETFs and all these are relatively similar in terms of how the fees are structured. How much does the investment cost me and how much does the advice cost me? I used to say I would happily pay 7% if I'm getting 9 or 10% worth of value. If this person is doing my taxes and saving me lots of taxes and picking up my laundry and whatever the case may be, if they're doing all this stuff, right, and I'm like, this, I don't have to do this now. This is saving me a lot of money. So it's value for the fee, not necessarily the fee itself. If we are all fee conscious, we would all be eating at McDonald's 3 times a day for the rest of our life. Not the McDonald's is cheap
crazy
anymore.
Though. When I bring the family there, it's like $50-$60 now. I mean, my boys are getting older, so they eat a lot more. And it's funny, my boys don't eat at home, but then we go to McDonald's and they want like the Big Mac and large fries. It drives me crazy. But I think the fee structure in Canada is very different than the States. I wish we moved to the US model, which is more like an RIA model. It's more like what we do here at Parallel Wealth, but it's really around like, here's what you pay for this, here's what you pay for this. Like, it's the unbundling of everything. And more firms here in Canada are doing that. But I think a lot of consumers, i.e. you, the viewers and listeners, have moved away from your advisor because you're like, I was getting nothing for my fee, right? And then they go full DIY and it's like, well, this is a different beast altogether as well. So I think there's this middle ground that our industry is slowly, and I mean very slowly, coming to. We've seen it work well in the US. That is, I would say 90% of advisors in the US have this middle platform.
Yeah.
We're trying to encourage, and every advisor I talk to, like, move to this middle ground. Like, this is where it's going. What we're actually seeing, some of what we're seeing is actually advisory firms add in the asset management internally. So it's like, well, I don't want to give up that fee, so I'm going to bring it in-house. And it's like, well, is that what you do well, right? It's like, well, no, but we'll find a person. Okay, sure. So again, it's just a conversation with your advisory team to figure out, like, is this the right solution for me?
And I would say the one key thing to remember about this part of the discussion, you mentioned, like, what am I paying you for when you're talking to your advisor? I would actually change that to what's the total that I'm paying and what am I getting for it? Because if you ask an advisor, what am I paying you for? They could truthfully answer only part of the fee. They could truthfully answer, well, you're paying me for this 0.75% of this 1%. And we hear from clients all the time, my advisor charged me 0.75%. Okay, well, that's not the whole fee. It's like saying my car mechanic charged me $50 for oil. Okay, that's the oil, but what about the oil change? I don't know if oil costs $50. I might have
Probably
to talk to
yeah.
my.
No, it
I
is
have to
true
talk
though.
to
I
my
mean, yeah, we
mechanic.
bump into that a lot, where people are like, oh, I'm only paying 0.75. It's like, yeah, but your funds that you own are 1.5, so you're actually 2.25, right? So, and this is, I won't go down this rabbit hole. Yeah, but this your CRM2, which was launched years ago, which was like more fee transparency, and the banks got involved and they said, well, this is how it should be, and they won. And it's like it was only one fee going out to clients, so clients thought they were paying less than they are, and it's a big mess. Like so all you viewers, all this to say is all you viewers and listeners out there, I don't blame you for being frustrated, but it's at the end of the day, it's your money and your fees. Ask the tough questions. What percentage am I paying and what dollar fee am I paying on everything that I'm paying? Like, what is my total cost here? I think that's a fair question that more of you need to be asking. So
absolutely.
Yeah. And to wrap this up, I have a little tip for our viewers here. Brett, if you have one, throw one in. This is, again, unscripted a little bit here. But
Sure.
One thing we hear again and again is, if I convert my RRSP to a RRIF, so I've retired, I'm going to start drawing down income. I've converted my $500,000 into my RRIF account. I start drawing that down. And I sell a rental property, or I go back to work, or I have some other income, and I don't want money out of my RRIF next year, let's say, or this year. Like I want to convert it. This is pre-71. So retired at 60, converted to a RRIF, but things have changed. Can I convert it back? The answer is yes. So any time before age 71, you can convert your RRIF, retirement income fund, back to your RSP, your registered retirement savings plan. So if you convert to a RRIF, it doesn't mean that you've now gone all in on retirement. Life changes. You might go back to work. You might have a rental property. You didn't expect to sell it. You did. So again, you got to plan ahead. The year that you convert back to a RRIF, or back to an RSP, there's still a RRIF minimum. So let's say 2025, you have your RRIF and you're going to sell your rental property this year. Well, you still have to take the minimum. But if you can bump your sale of your property to next year, or maybe you're going back to work next year, convert your your RRIF back to an RSP in 2025. In 2026, you won't have to take any money out of there. You can just leave it and, kind of rebuild your retirement plan, obviously. But that is one thing you're able to do before age 71.
Yeah. Yeah. And my tip, I'll just continue along that idea that what I used to tell clients to do, or still tell clients to do, is if you're not sure, keep your RSP open. So you've got your RSP, you open up a RRIF, you transfer X amount of money into your RRIF. And even if you're thinking, well, I don't need this RSP anymore, I'm just going to transfer everything into my RRIF, leave $500 in the RSP just to keep it open. And there's no real big idea there other than the fact that you just don't have to open another RSP if you have to go backwards. Yeah, you still have your RRIF minimum that you talked about, but you've got two accounts and you can just transfer back and forth. You're going to have to transfer anyways, but you're just avoiding having to open an RSP again. And so you're just hedging your bets a little bit just by making it a little bit more convenient for you by leaving that RSP open with a small little amount left in it. And then when you're done, you just close it all out.
Yeah, absolutely.
Yeah.
Perfect. Well, Brett, this has been fun. First episode done. Hopefully many, many more to go. And again, if you have comments, feedback, question for future podcasts, leave those comments below, questions below, and we'll get through them here in a future podcast.
Absolutely. Yeah. Thanks, Adam.
Thanks for joining us on this week's episode of Retirement Unpacked. If you found today's conversation helpful, don't forget to subscribe so you don't miss next week's episode. And remember, the ideas we talk about are general in nature. They may not fit your personal situation. Always consult a qualified financial planner before making decisions about your retirement. Take care, and we'll see you next week.